What's going on, everybody? In today's video, we're going to be looking at the newest functionality for the Jericho system. We're going to be reviewing how the SubTo and hybrid LOIs are being constructed. And so if you aren't already familiar with the Jericho software that's been developed, I will leave it in the video description below, a link that you can check it out for yourself. And if you've already acquired the Jericho system, then this video is specifically made for you, for this will be a tutorial on how the functionality is being processed. So let's begin. I'm going to minimize myself here on the screen. And if you head on over to your version of the Jericho system, head on over to the list of leads. So we're both looking at the exact same thing. So here we can see here that we've got two different functionalities to auto-generate your LOIs. We have the SubTo LOI and we have the hybrid LOI. Both of these have separate macros involved. And so those macros are going to be calculating that math for you. And the math is actually being pulled directly off of these columns here. So you'll have access to these columns and you'll have access to how the math is being extracted and calculated. And so for the subject to down payment that the seller is going to be receiving is based off of the list price. Now, why are we doing it based off of the list price? Because in most cases for a subject to transaction, there's already very little equity to begin with. And so the seller is aware of that. And so they're going to more than likely list their property above the current market value that it probably is. And so we don't want to offend the seller. So we want to go based off of their list price. And we're going to give that down payment as a non-refundable to them at closing, which will be part of the LOI that's presented to them. And that would be a follow-up conversation that you have with the agent or with the seller as well, as that is going to be your security down payment towards the property, so that they know that you aren't going to flake as a buyer, that you have an invested interest to continue paying down that mortgage payment that the property will have. And so the macro is just based off of the current list price and not the market value of the property. Now that is different for the hybrid LOIs that are being constructed. The hybrid LOIs is based off of the market value. And in most cases, those properties are not necessarily overpriced, but the longer that it sits on the MLS, the lesser attraction that property has, because in most cases people will look at that property and think that there's something wrong with it. And in my opinion, I think exactly that type of mindset. And so for me, I've calculated the market value on this spreadsheet, which will automatically do it for you. You'll find it over in column M, and it's basically going to deduct from the current list price every 30 days that the property is sitting on the MLS, there will be a deduction off of the current list price. And we're doing that on purpose because, in all honesty, if a seller or a listing agent cannot sell their property within 90 days of it being on open access markets such as the MLS, which is the largest platform to sell any type of real estate property, if that property can't be sold within 90 days, then we should not be paying the current list price of the property because it would have sold by 90 days. And if it hasn't, then there's something wrong with it, or it's probably overpriced to begin with, right? And so the macro that's running for the hybrid LOIs is based off of the market value, which you'll find here on column M. You'll have access to the formula as well. And so it's basically taking the list price, and every time the days on market increases, which is based off of column B here, the longer the days on market, the more of a deduction that's coming off of the list price. So you need to have the days on market in order to calculate your hybrid LOIs. Don't leave this blank. And if your property is off market, for example, let's say you have a pocket listing or you're direct to seller, then make up a days on market. Maybe you want to use a 90-day rule or 120 days. Use some kind of number to associate that off-market property that you're looking at, because that's going to give you your estimated market value. And let's see. The rent value here is going to be very important for the hybrid LOIs. You must fill out the rent value. You do not need the mortgage statement to calculate the hybrid LOIs because this is based off of simplistic math. And so in most cases, when you're having a conversation with a seller or with the listing agent, 9 times out of 10, they're not going to give you the mortgage statement right off the bat, even after a first phone call or after an email exchange. Very rarely do they give you the mortgage statement for that property because it's private information. So you need to build rapport with them first. And so because we're blasting out these offers to sellers, it wouldn't make any sense to have a follow-up email or an email prior saying, hey, by the way, can you send me over your mortgage statement so I can verify that this is a property that I want to be paying for and whether or not I can cash flow? So we're not even going to be looking at that. It's optional. If you want to include the estimated PITI in column J, you absolutely can. It's not necessary because the macros are not pulling from this column. The macros are pulling from column K, which is your estimated rent value. And if you want to know how that's being calculated, it's basically looking at how much of the cash flow is going towards the seller for the hybrid transaction. And in most cases, you want to be at 10% or less of the rental value. So for example, if you know that the rental market is $2,000 for that property, then you know that your hybrid LOI that's going to be sent out to that seller, that monthly payment that the seller is going to be receiving will not be more than $200 a month. So that's what the 10% is. There's a cap. And so this is based off of pure mathematics. We don't need the mortgage statement to calculate the hybrid LOI. I know from experience that in order for this property to cash flow, there is going to be a cap as to how much money the seller can receive because you're already taking over the existing mortgage payment as well. And so now to have a second note associated with the seller, it's going to overcomplicate things. You're going to have taxes, insurance, property management, repair reserves. And so that all adds up and that eats away at your cash flow. So the maximum that the seller could receive is 10% of the rental value for that property. So even if you don't end up using the Jericho system, that's a good nugget for you to be aware of because that's going to help you underwrite your deals a lot quicker. So let's take a look now at columns M and N. And so we can see here that we have conventional sale fee and creative sale fee. So what's the difference? Well, with a conventional offer that the seller is going to be receiving, such as a cash or just a traditional conventional offer where there's another lender coming involved, bringing money to the closing table, there's fees associated with all of this. So if you have 2.5% going to the listing agent, which would be the bare minimum, and you have about 1% towards closing costs and miscellaneous fees with the lender, that's where the 3.5 is coming from. So this is looking at a best case scenario. I always look at best case scenario for conventional offers. Now, is a listing agent necessarily going to have a commission of 2.5%? Probably not if the property is listed at, let's say, $200,000 or less, because a 2.5% commission at that type of list price would be very little commission. A 2.5% at $1 million property would be a much greater commission, right? But we want to be looking at best case scenarios because then we're going to take the best case scenario that the seller could receive and compare and contrast that to your creative offer. So we're doing this on purpose to show the seller that even on a best case scenario for cash or conventional offers, it will still lose to a creative offer. That creative offer will outcompete the best case scenario that the seller could receive. And so that's what we're looking at here. So typically also on creative deals, you have about 0.8 for closing costs, always going to be less. I have multiple properties closed. If you compare the HUD statements for a creative deal compared to a traditional cash closing, you can do the math out on your HUD statements and you'll see that the creative closings are typically cheaper. Not substantially, but it still adds up at the end of the day. And so now let's take a look at what these rows here are. So still looking at column N, and it looks like we are in row 6. So we have cash percentage for the SubTo offer, then we have cash percentage for the hybrid offer. So what's the difference? And what does the 88 and 85% signify? Well, for SubTo offers, we have to remember that the seller is already in a particular situation where they have a very low equity on the property. And so in most cases, when I'm making a subject to offer, the cash offer is a bluff cash offer. It is not a cash offer that I know that any private investor or a hedge fund or even myself would be interested in, because that is a cash offer that is way too high. And so what do I mean by this? We're giving them about 88% of the list price. That's what the 88% is referring to. I'm not looking at ARV because ARV requires me to look at all the last 90 to 120 days of recently sold comps, and I don't have time for that. I need to be able to make an offer quickly. So the best way to make a quick offer, especially when you're doing an email blast to sellers, is to look at the current list price and do your cash offer based off of that. Because what we're looking for with these email blasting of offers is looking for motivation. How motivated is the seller? Are they motivated enough to consider a subject to offer, knowing that the cash offer is already way above expectations? So the 88% is looking at the list price. So if we have a $300,000 property, take 88% of that, and that would be your cash offer. And what I'm trying to create this type of perception and illustration to the seller on the LOIs. So if I go over here to the SubTo LOI, I can better explain. They're going to be receiving an LOI to this. So they're going to be looking at conventional versus creative. And I want them to understand that even on a very good cash offer of about 88% of the list price, which is completely unheard of, because I shouldn't say it's completely unheard of, but it's rare. Most cash offers are looking between 65 up to 75% of the ARV, and we're at 88% of the list price. And so on a best case scenario, the seller is more than likely going to have to bring money to the closing table. And so when I'm looking at offers such as this, I want them to see that. I want them to see that they have to bring, in this example here, it's just random numbers here, but they would be bringing $38,000 to the closing table. Now, that's not a very attractive offer to bring $38,000 to the closing table. And so I want them to visually see that a cash offer or conventional offer at 88% of the list price is a good offer, but nonetheless, they have to bring money to the closing table. So that's what that number is referring to. This 88% is going to be for all your subject to LOIs that are being sent out. Again, we're looking for motivation. So then this 88% is going to be used for all the macro math involved. You can change this to 85, you can change this to 80, whatever it is that you want to do. I'm sticking at 88 because I'm figuring that I want the seller to have a visual that they may have to bring about $20,000 to the closing table. That seems to be about the sweet spot. 15 to 20 grand being brought to the closing table is enough of an incentive for the seller to now consider the subject to offer that's being presented to them as option 2. Because now they're going to be looking at option 2, and they're going to be looking at, well, instead of me bringing 22 grand to the closing table, how about I make $25,000 at the closing table, right? Because we're essentially just going to be paying out their equity difference. And so that's what I want them to get a picture of. And so for us, it just doesn't make any sense to be asking the seller, can you please send me over the mortgage statement? Or trying to figure out a very hard point of a cash offer to make. We're looking for motivation. We want this to happen quickly because if the seller is motivated to sell, they're going to respond back to you and be like, hey, this cash offer was a little bit low. Or maybe they'll come back to you and say, the subject to offer that you're offering, can you explain that to us? That might be a good option for them. So we're looking for motivation. That's what the whole point of this quick math that's being done for you. Now let's look over to the hybrid section. The hybrid section is looking at the exact same concept. We're looking at 85% of the list price. Now with this, you have more flexibility because in most cases, when you're looking at hybrid deals, most sellers might at this point already have about 50% equity. So you could, if you wanted to, drop this down to, let's say, 70% or even 75% of the current list price. If you don't know what the list price is because you have a property that's off market, then go based off of the market value of that property. But if you're working through the MLS, then go based off of the list price. Just make your life easier and try to find motivated sellers who are willing to sell their property quickly. If they're not motivated to sell, or if they say that they're not interested, then follow up with an email and say, okay, do you mind if I kindly follow up with you within the next 30 days? Or you could say something along the lines like, I understand that these offers that are being presented to you may not be so appealing to you at this moment in time. However, we really like the property. What could we do to adjust our offer? And just have a back and forth conversation and listen, find out what their needs are and make an offer according to that. And if you can come up on cash, great. If you can't, then stick to your creative offer that you're also presenting to them. So with the creative offer, it's going to be a combination of the subject to and the seller finance. And so, going back to the hybrid offer, I know this is a lot of information at once, but going back to the hybrid offer here, this 75% is going based off of the list price. And so with that in mind, you will have the flexibility in this type of transaction to take down the property yourself as the end buyer, or to sell it to somebody else as the end buyer, to assign the property if you have a low enough cash offer for that property, right? Because there's going to be equity in the existing property. You'll have a wiggle room to do an assignment fee, for example, for both cash and for creative. So the 75% is calculating the math for the macros involved for all of your hybrid properties. 75% is for that, off the list price. Now let's look at the gross rent to the seller. The gross rent to the seller, that's what I was referring to before. Don't go past 10%. So right now I have it at 9%. 9% of the gross rent of the hybrid property, the hybrid LOI that's being sent out. So if it's a $2,000 market value for rent, 10% of that would be $200. You can't offer more than $200 to the seller. And so you're not doing this yourself. Remember, this is being automated for you. So for right now, I have it at 9%. I have it just 1% below that. That seems to be a good sweet spot of, if I gave the seller the best case scenario of 9 or 10% of the rental value for that property, are they motivated enough to take my offer based off of a best case scenario? We're looking at best case scenarios for gross rent percentage to the seller. So never give them 3 or 4% of the market value, because they'll turn that away and you will never get a deal done. Always look at the best case scenario, because especially when you're blasting out these offers, because again, we're looking for motivation. Who's willing and ready to sell their property now? Because if they're not ready to sell their property at 10% of the market rent value going to them, then you know that you can move on to the next potential property and you won't be wasting your time, because you gave them the best case scenario. You didn't start at 5% or 6% of the rental market value. Can you? Absolutely, you can. But I don't recommend it. I recommend you just give them the best case scenario. And then if you need to adjust the numbers, because after you set out these hybrid LOIs, you're going to want to confirm the mortgage statement with the seller and do a manual and underwriting. So once they say yes to your offer, go back into the spreadsheet here for the cash versus creative and go into the hybrid section of the calculator and manually underwrite your deals. Super important once they tell you, yes, we're ready to move forward from your hybrid LOI. Now is your time to have a follow-up conversation if needed. If you need to adjust your numbers, you could have that conversation before your due diligence. You could have that conversation during your due diligence. But now is the time to do a manual underwriting. What we're doing is automated underwriting. We want to send out these offers quickly, and we want to find motivated sellers. Now, for the hybrid down payment, that's going to be the down payment that the seller is going to be receiving. So we want to be, somewhere between maybe 8, 12% maximum as a down payment. All of these SubTo macros that are running in the background, the maximum down payment that the seller is receiving on a SubTo LOI is 12.9% of the list price. That is how the SubTo category is being established here. There's three categories that will auto-populate on this spreadsheet: SubTo, hybrid, and seller finance. So if the down payment that the seller receives is 12.9% or less, which is their equity, then it'll be classified as a SubTo property. If it's anything more than 12.9% of equity, then it'll be automatically classified as a hybrid. If there's no encumbrances associated with the property, if there's 0%, zero mortgage balance, 0 liens, then it's automatically a seller finance deal, right? If this all sounds new to you and you're not understanding what the SubTo, seller finance, and hybrid is, I'll make a separate video on that, explaining further detail of what those categories are for property acquisitions. But let's go back into here. We've got the hybrid down payment of 9%. That's the number that I like to stick at, 9-10% down of the market value. So this is looking at market value. This is not looking at list price. So the market value will automatically be generated for you on this spreadsheet, because it's going to be looking at the amount of days that have passed since that property has been up on the MLS. We never want to give a down payment based off of the list price, because they could be asking for $1 million for that property, and the reality is maybe the market value of that property is only $800,000. So why would you give them way more for the property than what it's actually worth, right? So always look at the market value for hybrid and seller finance deals. For the subject to offers that are being sent out, there's a wiggle room in that, because in most cases, like I said, it's okay to go based off of the list price for your down payment because they already know that they have low equity and they need to find a way to kind of recompensate that low equity, right? So that's what this 9% is referring to. Now let's take a look at the hybrid over market value. Now, what is this referring to? Okay, the over market value. Since we now have the current market value of the property, and we want to incentivize the seller to take a hybrid offer as opposed to a cash or conventional offer, I want to give the seller more money for the property. Now, why would I do that? One, because I want to get the property, or two, I want to assign it, right? There's two options. So how do I motivate the seller to take my offer as opposed to a cash or conventional offer? I simply overpay for the property, but I don't overpay based off of what they want for the property. I don't overpay based off of their list price. I overpay according to the current market value of the property, which is automatically being calculated for you on this spreadsheet. So 7% over today's current market value of the property is completely different than 7% over the current list price of the property, because it could be listed at $300,000, but the property might only be worth $270,000. And so 7% over the market value and 7% over the list price is going to be a completely different final payout that the seller would receive for the hybrid LOIs. I hope you're following with that. So that's what this macro is referring to. So I have the flexibility now to overpay for the property, so to speak. Seller may not think you're overpaying for it because maybe the list price is much higher than what the market value is saying that it's worth. But the reality is you are overpaying for it, right? And so that's what that 7% is referring to. I personally don't go above 10%. The reason why I don't go past 10% of the market value is because I know that the average year-over-year appreciation value for most properties across the United States, the year-over-year appreciation value is about 2.5% year-over-year. And so if that's the case, and I pay 10% over the market value, then I know I need approximately 3 to 4 years for that market value of the property to catch up to how much I paid for the property initially. And so when you're structuring a hybrid LOI, in most cases, the seller doesn't want to be waiting around for 30 years to collect their balloon. In most cases, they want their balloon between a 5 and 10-year period. And so you have to keep that in mind, because when you do a balloon payout to the seller, you want to make sure that that balloon payout that's being received by the seller is going to be less than what the market value of the property is, because if you decide to sell the property, you will have equity, right? You want there to be equity. You want the balloon payment that the seller is going to receive at the end of the term to be less than what the market value is. That way you have equity to sell or refinance on the property. And so the 10% is just referring to that. How much am I willing to overpay for the property? So in this case, I'm willing to pay 10% over market value, which would be pretty significant. If we're looking at $1 million property and you're paying 10% over, then that's another $100,000 in the seller's pocket, right? And so that's what that 10% is referring to. The macro is being calculated for you. These are the only boxes here that you need to manipulate. The math is going to be completely automated for you, and it'll be put on the LOI spreadsheet, which is over here. I'll move myself a little bit here on the screen. And so we can see here that if we just change this over here to the auto input, the math will be done for you. Cells that are highlighted in yellow, don't touch those cells, because the macro is going to be converting the mathematics for that individual property in those specific cells that are highlighted in yellow. If you decide to maneuver these cells around, you might cause some issues with the macro in the background. So I don't recommend you touching that. And so this is essentially all you need to know on how to calculate the SubTo and hybrid LOIs. For the SubTo LOIs, you don't need the mortgage statement. For the hybrid LOI, you also don't need the mortgage statement. All you need is the rental value, and that rental value will be put into column K. You could put it into here, the rental value. You put in $2,000, it'll automatically be put into the next row. If I put it again, let's say rental value is $1,500, it'll automatically be transcribed down to the next cell. So this specific spreadsheet is coordinating with, I think this is row 2. So anything that you implement in row 2 will automatically get pushed down into your lead generation autosave template down here below. That just makes it easier on everybody. That way we're only working at one row at a time. and it'll just push the data down as you move along by looking at other properties throughout the day. So that takes care of the SubTo and the hybrid LOIs. That's pretty much everything you need to know. Again, the math it's visible here on the screen for you in case you want to take a look at it. If you want to manipulate the math, you can. I don't recommend you do that. But if you want to manipulate it, you can. The next update that I include into the Jericho system, which would be the 3.0 version, I'm going to be looking at the seller finance mathematics or the macro. Now, you might be saying that the seller finance will probably be easier compared to the hybrid LOI, which normally I would say yes, it would be easier, but I'm not going to be doing traditional seller finance. I'm going to be doing reverse seller finance. And if you don't know what that is, I don't blame you. It's because it doesn't exist. At least it's never been taught to anybody. You won't find it on YouTube. It's a creative way that I found to take down properties through seller finance, but in a more beneficial way for the buyer and a more beneficial way for the seller as well, especially in terms of visualization purposes. So the next update that I include onto the Jericho system will be the 3.0 version, where we're going to automate all the seller finance LOIs. So stay on the lookout for that next update. I'll probably get that done within maybe the next week. And within that same time frame, I'll also be starting up a new Discord specifically oriented for the Jericho system. If you have any questions, if you want to add new features, anything like that. And then we'll also be implementing some strategy sessions and some just one-on-one time, and even some group live events. If anybody wants to learn more about real estate, how to talk to sellers, agents, how to underwrite properties, that new Discord is going to pretty much encompass everything so that you can get the most value for your time and that you can learn the most as well. So this concludes today's video. This is going to be the Jericho 2.0. It's a live demonstration and an explanation as to what the functionalities are for this new system. Thank you for watching, and I'll catch you on the next video.